Okay, Warren Buffett just sold 13% of his entire Apple holding. That's insane. What the hell is going on? Now, last quarter, when he sold 1% of his holding, we were like, okay, he's just trimming. But at 13%, is that really just trimming? Is this the end of the Warren Buffett Apple love affair? Or is there something else here that has nothing to do with Apple? The answer, as always in everything in life, lies somewhere in the middle. Some of it has to do with Apple, some of it does not. But it's not as simple. It's a little bit more nuanced. Now look, it's still Warren Buffett's biggest holding. Don't get me wrong. $140 billion, that thing is a behemoth. Now, you know this famous saying, there's only one reason to buy, but 1,000 reasons to sell? That fits this scenario perfectly. Now, what Warren Buffett said during the shareholders meeting of Berkshire Hathaway yesterday, when he was asked about this, was one simple thing. He basically said, look guys, this was a tax-driven sale. For two reasons. Number one, we have accumulated a lot of taxable gains, which we need to pay for, which means we need liquidity, which means we need cash. And number two, I personally think that the corporate tax rate in the United States will have to rise in 2025 because of how much money we owe. And we have to pay for that. And they're going to tax the corporations more. That's what I personally think. And for me, it's better to pay the tax right now at the low rate before it goes up. And that's all fine and dandy, but ask yourself this one question. If Warren Buffett requires liquidity, it requires cash, and he needed to sell some shares to finance a tax bill, that's fine. Why sell Apple instead of any of the other slew of stocks he has in his portfolio? Why specifically Apple? I'll show you in this video. It's not going to be as simple as Apple bad, Apple good. As anything in investing, it's going to be highly nuanced. And this video is not for you to shit on Apple or to say that Apple is the best thing since sliced bread. It's probably the more nuanced answer that you'll hear about why this thing happened. Now let's go to the computer and I'll show you. So what exactly is Warren Buffett doing with his Apple investment? That's the question on everybody's mind. We just had the annual shareholders meeting of Berkshire Hathaway, and this is one of the main stories that came out from it. And I think it's very important to talk about it because, as you can see here on the screen, Berkshire Hathaway dumps about 13% of their Apple shares. And that's a huge, huge question of what exactly is going on. Now, Warren Buffett already sold a little bit of Apple in the previous quarter, but that was about 1% of his investment. This time, it's 13%. So is Warren Buffett losing trust in the company? Is he not seeing Apple growing anymore? What's going on here? Now, as we take a look here on Stock MVP on the Apple stock chart, over the past 3 months, the stock is down 2%. Over the past year, the stock is up slightly, 9.5%. So nothing crazy. But look, at the end of the day, people have a lot of reasons to sell stocks. You know the famous saying, people have only one reason to buy a stock, but 1,000 reasons to sell one. It's very true. There's a lot of reasons, tax reasons, loss harvesting. There's a lot of different reasons. So the question is, did he sell Apple because it's a bad company, or did they have an excuse, a reason that has nothing to do with Apple's qualities? And I think the answer is kind of in the middle. If you allow me 2 seconds, I'll explain what I mean. You see, this is still Buffett's biggest holding by far. Apple is currently $140 billion of Apple stock is being held by Berkshire Hathaway. And I don't think he's going to dump those shares. I think there's a lot of reasons for him to sell the stock, and I'll show them in a second. And according to Warren Buffett himself, when he was asked about this directly, this is a tax-driven sale. Essentially, they have a very high tax bill for 2023. They need liquidity, they need cash, and this is where they took the cash from. He also mentioned that he thinks that the US might or may or probably will increase its corporate income tax rate. In that case, it makes sense for them right now to take a little bit of profits at this discounted rate before the US actually increases the corporate tax liability. Again, we can speculate about all these things. He did say it, so I believe that this is the main motivation here. But the question you should be asking yourself is this. If you need capital, if you need liquidity, you can sell a lot of different stocks. Why sell Apple stock, right? That's the question you should be asking yourself. His cost basis is in the 30s. So we can probably track it all the way here. So right now we're talking about a guy who has 4.5 times of profits on his original investment. So it's in a massive profit position. So anything that you have massive profits on, you always want to consider as a candidate to trim in order to generate some liquidity. So that's reason number one. And that's a fair reason that has nothing to do with Apple. But there are issues here that have to do with Apple. And I'll show you one slide on the screen that's going to make it very obvious why Apple and not anything else. But it doesn't mean that he's going to dump Apple going forward. In fact, he was asked about this and he says that, he's predicting that Apple will be his number one holding even in 2024. So they're not planning to liquidate the position. Nothing has changed fundamentally for this stock, at least for Berkshire Hathaway. And overall, the company looks terrific. $380 billion of revenue, $100 billion of income. Over the past 5 years, the income is up 75%, revenue is up 47%, free cash flow is up 70%. So everything here looks good. It's a solid business. It's an extremely solid business. But there's two glaring issues here that if you are part of my academy, you already know the answer to. But those of you who are not part of the academy, I'm going to let you in on a little secret. There's two things here that made Warren Buffett sell the stock, even though it's a great company and even though he will plan to keep a lot of it still on his books. But this is the reason he chose this stock and not anything else to generate that liquidity. Number one, the growth rate has been slowing down. Over the past year, the growth rate is down by 1%. So they're not growing as fast as their competitors, which I'll show you in a second. The other thing is, if you look at forward PE and current PE, they're 28, 27.6. So they're trading at 28 PE forward and current, which again is a little bit on the high side compared to their competitors, which are performing better in growth and in outlook. Allow me to show you what I'm talking about. Now, these are the comparables I want you to pay attention to. If you look at these three companies right now, let me show you something. You have revenues for Meta growing at 21% over the past year. Revenues for Google are growing at 11.7% over the past year. Apple is down. So Apple is not growing as fast as the other guys. In fact, it's slowing down. If you look at operating income, up 92%, up 29%, up 5% for Apple. It's too slow. Net income, up 113%, 40% for Apple, 6.4%, slowing down, not the same speed as the competitors. Free cash flow, very similar story, 180%, 11%, 4%. So they're dead last in every single category here. Now, if we scroll down here and we take a look at these numbers right here, what you'll notice is a few things. On the price to sales ratio, the most expensive company we have here is Meta with 8. Now, at 6.5, you can buy Google. Now, at 7.4, will you buy Apple? Now, if Apple is the third best out of these three as far as growth, as far as cash flow, as far as the way the business is kind of projecting forward for the next 5 years, and they don't really have an AI play yet, right? So if they're trading at 7.4 and you can get Google at 6.5, which one would you choose here? Same with PE. Look, Google is trading at 22 PE, forward PE, Meta at 19 PE, and Apple at 27.6 PE. So they're the most expensive company of the bunch on the forward PE basis. They're also the most expensive on current PE ratio, 25, 25, 28. And they're very, very close to being number one. They're close second in the price to sales. So they're the most expensive company in the whole group as far as ratios go. And they're not that much better. The profit margin is slightly better than Google's, but not as good as Meta. And everything else, they're dead last. So in this case, it's clear that it's a good business, but it is currently being mispriced. It's a little bit on the top-heavy side compared to Google, compared to Meta. So as a capital allocator, Warren Buffett is saying, look, we need to trim this. So the bottom line here is very simple. Warren Buffett still loves Apple. The fundamentals are solid. But at its current rate of growth, until they come up with a new plan to integrate AI into their business, at this price level, it's trading very, very high at a premium. And if I'm Warren Buffett and I already have 4.5 times of profit on my investment, this is the place where I'm going to trim off some fat. And this is the perfect place to do it. Does it mean that Apple is over and it's finished and it's on the way down? No, that's not what it means. It means that this is the most appropriate price for Berkshire Hathaway to trim at this position where they have lots of gains and it's trading at a crazy premium. And it's currently not doing that great compared to its competitors, comparables. And for those of you who are wondering, the platform I've been using in this video to showcase Apple's fundamentals is called Stock MVP, stock-mvp.com. It's my platform. I helped build it. We just passed 5,000 paid members. You are welcome to try it out for 1 week for free. stock-mvp.com. Try it out. I'm sure you're going to love it. If you actually want to get better at this game and identify opportunities like this, I'm not saying you're going to make 4.5 times on every investment you're going to make, but consistently make good returns and build a sustainable income source for yourself. Join the Academy. We have a few spots left for the $35 tier right now. 2 or 3 spots left. Check it out right now. Payoneer.com/Tom Nash. After these spots are filled, they're gone forever. We're going on to the $99 tier, and that's just the way it is. If you don't like it, drink some water, breathe some air, everything will be okay. Now, we just passed 10,000 members on our Discord. That's a huge milestone. You're more than welcome to join. It is free to join. Discord.gg/Tom Nash. We would love to see you there. Come be the 10,001 member, I think, at this point. I'll see you in the next one. Bye.